Hello my dear warriors, I hope you guys are all doing amazing. Welcome to this most amazing session. So I'm very excited. What are we going to do here? We are going to have a quick rocket revision of the entire chapter Forex. The most challenging chapter considered to be in less than 30 minutes. Now, a very important caveat before we get into this. Point number one, this is not going to be a conceptual discussion. Is the entire conceptual discussion of Forex with questions will be taking somewhere around 30 plus hours. Even if I have to explain you the concepts alone logically, it will take me 12 to 15 hours. We had a 12-hour comprehensive revision. This is not that. Here we are just inking all the things and creating a quick summary in 30 minutes so that the students who have listened to the class already, they can summarize things in less than 30 minutes. Point number one. Point number two, if you are someone who is learning Forex for the very first time, doesn't know anything about Forex, it is better not to watch the video. You can watch it for entertainment purpose, but will you understand? No dear. Okay, I can explain you each and everything. Yes, why I am adding a particular item, why I am reducing it, each and everything, but it will take time. 30 minutes is not going to be possible. Okay, yes, the next important thing is, yes, if you have referred some other faculties classes, the steps there and here could be slightly different because AFM is a subject wherein there are different ways to solve answer. You will arrive at the same answer so long as you're doing it logically. So it is going to be fine, no issue. Okay, so it's a very new thing that I'm trying from my end to ensure that once a student has studied a chapter, yes, he should be in a position to revise it in less than 30 minutes. Main objective is for our students, those who have purchased our classes, so that subsequently they can revise the chapter in less than 30 minutes. Okay, so if you have loved this attempt, it has taken a lot of efforts, so do like it, do share it with all your friends, do put a comment. It really motivates us. Okay, now the notes are available on our Telegram group. You can refer it from there. So shall we start, everyone? Yes or no? So let's begin, my dear warriors. So the entire chapter of Forex, we are having altogether 6 concepts. Concept 0, that is the background. Firstly, 2 countries are there. Yes, 2 countries will be having 2 different, yes, currencies. So the rate at which one currency is converted into other currency is called as my exchange rate. It keeps fluctuating on a continuous basis. Now, why are we studying this chapter in the first place? What is the risk that I'm having when I'm doing a foreign currency transaction? Now, understand, foreign currency transaction. Yes, I will be taking a foreign currency as US throughout this entire chapter. Okay, either I'm having a foreign currency receivable, I'm receiving money from US, or I'm having a foreign currency payable, I'll have to pay money to US. Foreign currency receivable, ideally, I want to get more money. That means ideally, I want receivable to be more. That means what is the risk I'm having? I'm having a risk that my foreign currency receivable will reduce. That is, my foreign currency will depreciate. Okay, when I'm paying, ideally what I want my payable to be less. That means what is the risk I'm having? I'm having a risk of foreign currency appreciation. My foreign currency goes up, I'll have to be paying. Is this clear, everyone? Okay, sir. Next comes concept 1, basics. This is going to be the entire base for the chapter. Okay, first is part 1, base currency and other currency. Imagine rupee per dollar. Dollar 1 is equal to 80 rupees. What does it tell? For $1, I have to pay 80 rupees. Yes, what is a base currency? Here it is dollar. Yes or no? Base currency, it is the currency for which price is given. I am expressing the code for $1. How is it expressed? In terms of rupees. It is called as price currency or other currency. Okay, sir. Next we are having part 2. Yes, that is different types of exchange rate. 3 different types of exchange rates are primarily there. First is bid and ask, spot and forward, merchant and interbank. One by one, let us try understanding. Bid and ask rate. Imagine rupee per dollar. Dollar 1 is 80/82. Here rupees 80 is going to be bid rate, 82 is ask rate. Sir, what is bid rate? It is the rate at which dealer will purchase base currency. Dealer will purchase base currency. Okay, what is ask rate? It is the rate at which dealer will sell base currency. Okay, boss. The difference between bid and ask is called as spread. It is a margin earned by the dealer. Okay. Golden rule for the entire chapter. Whenever you are going to select the rate, first think in terms of base currency and think from a dealer's perspective. Okay. If our dealer goes to the next dealer, rate determination will be done from the other dealer's perspective. As simple as that. Okay, sir. Spot rate and forward rate. If transaction is happening today, at which rate it will happen? Spot rate. Transaction is happening in future, but for that I want a rate today. Today itself I want to set a rate. That is called as my forward rate. Okay. Yes, premium or discount. The difference between my spot as well as forward rate is called as premium or discount. Yes, if my forward rate is increasing, it is called a premium. Forward rate is decreasing, it is called as discount. Okay, if bid and ask is available, I'll be doing the calculations separately. Okay. How will I calculate forward rate? Yes, today what is the rate? Imagine 80 rupees. Suppose question is telling in 3 months it will increase premium by 1 rupee. I will add premium. Suppose question is telling, okay, 80 rupees is today. Yes, 3 months it will reduce by 1 rupee discount. Yes, for spot rate, premium I will add. If there is discount, I will reduce. I will arrive at my forward. Okay. Very important thing. How do I present my premium or discount? Premium will always be in ascending order. That is first low, then high. Suppose question is telling 3 bar 5. Ascending order, it is premium. Suppose it is in descending order, say 4/2. Descending order, it is going to be discount. So how all questions can come? Firstly, yes, in the question, it is a specified premium or discount is specified. In that case, what I have to do? Suppose question is telling, okay, 3-month premium is 3/5. Okay, it is premium. I'll have to add it. Fine, but ensure that it is in ascending order. Otherwise, you write it in ascending order and then do the calculation. In case of discount, question has specified it is discount. Ensure it is in descending order. Okay, otherwise you first write it in descending order, then do the calculation. Okay, the term premium or discount is not specified. Question is just telling 3-month swap, 3 bar 5. I will see if it is in ascending order means it is premium. If it is in descending order means it is going to be discount. Okay, yes sir, it is okay. Then comes third type of rate, which is merchant rate and interbank rate. Transaction is happening between two dealers. It is called as interbank rate. There no exchange margin is considered. Transaction is happening between a dealer and a final customer. It is called as merchant rate. It is called as merchant rate. Here my exchange margin will be adjusted. How will I be adjusting my exchange margin? In case of bid, I will be reducing it. In case of ask, I will be adding it. Now sometimes I'll fumble for words because of the pace at which I'm speaking. Okay, for you guys, because it will be on YouTube, after every concept you can keep pausing. So much data is getting processed, okay, at one stretch. Okay, now blast from the past. Suppose question is telling you contracted rate, final rate book with customer. It is a final rate, no more adjustments are needed. How do we interpret different rate? Suppose question is telling, okay, $1 is 80.4111/25. Does it mean, yes, bid is 80 rupees, ask is 25? No boss. What does it mean? Yes, in this case, I will be replacing in the last digits of decimal. I will write it as 80/4111/80/4125. Is this clear? Okay, sir. Swap points are given. Yes, whenever I'm having swap points, 3/5, 5/3, what will I be doing? Yes, I will be adding or reducing from the last digits in the decimal. Suppose question is telling today's dollar is 90/90.75. Premium is 25/75. Will I be adding 25 rupees? No, boss. Yes, it is swap point in terms of decimal. From the decimal last digit, I will be doing the calculation. Okay, boss. Then suppose question is telling that, okay, on 15th November, quotes are as follows. Spot $1. This is a spot rate for 15th November. Spot/November $1. What does it mean? Yes, if question gives you spot/ the month, yes, it means it is a forward rate for any date of that month. Okay, spot/ a specific date, it means forward rate for that specific date. Okay. Steps to solve a question. Yes, what are the steps we will be following? Yes, step 1, we will identify the base currency. Entire question on Forex. These are the 5 steps we will be doing. First, we will see in the quote what is the base currency. Then we will see what customer is doing with the base currency. Step 3, we will see what dealer is doing with the base currency. Based on that, we will identify the relevant rate. If dealer is buying base currency means bid. If dealer is selling base currency means ask. Based on that, finally we will be doing conversion using a cross multiplication. Now, while we are selecting the rate, yes, final, if transaction is happening in the spot market, yes, what is the final spot rate? It is a spot rate given plus or minus exchange margin. If transaction is happening in forward market, it is a spot rate plus or minus premium discount. Premium I will add, discount I will reduce. Yes, then again plus or minus exchange margin. How do I adjust exchange margin? Bid means I will be reducing, ask means I will be adding. Is this clear, everyone? Yes, if question is asking you to calculate forward rate for a broken period, suppose 2 months premium is given, say 3/5, 3 months is given, assume 5/7. Question is asking for 2.5 months, how much it is? Interpolation, you guys calculate. Is this clear, everyone? Okay, concept 1, part 1 is over, part 2 is over. Now part 3 is calculation of premium or discount. Okay, how much premium or discount is there? We'll have to calculate. 2 different ways for us to calculate. First, using exchange rate. Second, using interest or inflation. Now, exchange rate. Suppose question is telling that today spot $1 is 80 rupees. Yes, 3 months later, $1 is going to be 82 rupees. Formulas are there. We are not going to touch the formula. Very simple way. Imagine today $1 is 80. 3 months later, it is becoming 82. From 80, it has reached 82. That means what happened to dollar? Dollar has increased by 2 rupees. From where? Where it was there originally? 80 rupees. So I'll tell 2 rupees it has increased, boss, from 80. So whatever is a percentage you got. Simple. Yes, if question is asking you annual, okay, this was for 3 months. Convert it into for 12 months. I will tell 3 months it was 2.5%. 12 months how much? Cross multiplication. Is this clear, everyone? Okay. Premium or discount in other currency. Again, yes, very lengthy formulas are there. No need to by heart at all. Simple. Now, just understand one very simple thing. If one currency increases, other currency is going to decrease. Now, very simple thing. Quote was $1 today was 80. Yes, 3 months later it became 82. Yes, my base currency is increasing from 80 to 82. That means my other currency is reducing from 82 to 80. So what happened to my other currency? From 82 it is coming down to 80. How much it reduced? It reduced by 2. From where? From 82 into 100. It will give you, yes, the depreciation or fall in other currency. Then it was for 3 months. Convert it into per annum basis. Simplest thing in the world, my dear students. Is this clear? Okay, sir. Next is using interest rate or inflation rate. Yes, as per IRP theory or PPP theory, one simple observation was there, that if my interest rate or inflation rate is lower, that currency will be at the premium. Interest rate is higher, that currency will be at a discount. So based on that, we'll have to do the calculation. Simple example is there. Imagine in rupees, yes, interest is 12% per annum. Yes, in dollar, interest is 5% per annum. For 6 months, I want to see what is going to be premium discount. Simple. First, it is for 6 months. So whatever the interest rate is there, I will first convert it into 6 months. I will tell, okay, boss, 12% means 6%. Yes, dollar, it is 5% per annum means it is 2.5%. Step 1 over. Step 2, yes, I will put a principal base of 1 rupee. On that, how much will be the amount I will calculate. I will tell, boss, in India, if I invest 1 rupee, 6 months, 6% interest I will get, I will be getting 1.06. In US, if I do 2.5% interest, I will be getting 1.02. Yes, now calculate premium or discount. Simplest thing in the world. So many formulas are there, no need to study at all. Simple logic, students. Now tell me what is happening in dollar. Dollar is at 1.025. Yes, it is going to reach, rupee is now at 1.06. So dollar is increasing from 1.025 to 1.06. It is increasing by 0.035. In terms of percentage, can I calculate? Yes, sir. It is 0.035 divided by 1.025 into 100. You will be getting the premium in dollar. Rupee, what is happening to rupee? Sir, rupee is falling. From 1.06, it is coming back. Yes, both are at parity. It is coming down to 1.025. Yes, it is reducing by 0.035. So rupee, it is reducing by 0.035. From where? From where? From 1.06. Yes, you will be getting the premium or discount for the respective currency. If you want, you can convert it into per annum. Is this clear? Yes. In the entire AFM, simple assumptions regarding the interest rate. Yes, interest rate, if nothing is given, we are always assuming it as per annum interest. Okay, and while we are calculating effective interest rate, if it is for 1 year period, normally we will be doing simple interest calculation. If it is more than 1 year, we will be doing compound interest calculation. Okay, sir. Then is conversion. Okay, yes, again, so many formulas are there. Simple cross multiplication, students. I'll just give you one simple thing. Imagine $1 is equal to 100 rupees. Yes, I want to know $10 is how much. Simple cross multiplication, 100 into 10. Suppose $1 is 100 rupees. I'm telling I am having 1000 rupees. How much dollar I will be getting? Cross multiplication, 1000 divided by 100, $10. Simple, no formulas needed at all. Okay, yes, if you are having more than 2 currencies involved simultaneously, we'll be using the concept of cross rate and inverse rate, which will be discussed later. Now is a calculation of inverse rate. How do I calculate inverse rate? Simple. Suppose question is telling $1 is 100 rupees. I want to know 1 rupee is how much dollar? Cross multiplication, it is 1 divided by 100. Yes or no? So inverse rate is nothing but 1 divided by exchange rate. Okay, yes, I'm doing ulta. Yes, but in case of two-way quote, just remember, in case of bid, it is going to be 1 divided by ask. In case of ask, it is going to be 1 divided by bid. I'm going to do the inverse, but it is going to be, yes, reverse. Yes, bid I will be doing 1 by ask I will be doing 1 by bid. Is this clear, everyone? Concept number 1 is over. Relax for a minute, we will continue. Let the things settle down in your mind. Yes, everyone. So next we are having concept 2, which is IRP, interest rate parity theory, as well as purchasing power parity theory. What IRP theory tells? It tells that my exchange rate is dependent based on my interest rate. Purchasing power parity tells that my exchange rate is dependent based on my inflation rate. Now both are going to tell you the same story, just that in IRP I am using interest rate, in PPP I am going to use inflation rate. I will be explaining only one. If you just change interest rate to inflation, you will be getting the other theory. Okay. Yes, what is IRP theory telling? It is telling, yes, if in one country, yes, interest rate is high, yes, that gain, it will be compensated. How? That currency will depreciate. Ultimately, no arbitrage exists. No person will be in a position to earn riskless profit. Okay, based on that, what calculation we are doing? Simple, yes, we have told that if interest rate is lower in one country, that currency will appreciate. Interest rate is higher in that country, yes, that currency will depreciate. But ultimately, one benefit is there, one disadvantage is there. So ultimately, no arbitrage. Yes, ultimately we are at equilibrium. Is this clear? Based on that, yes, two calculations we have to do. First is calculation of expected spot rate or expected forward rate. In future, what will be forward rate? Imagine today dollar one is equal to 80 rupees. Yes, 6 months contract it is there. Dollar interest rate, rupee interest rate is given. Here, what will be the value of dollar? I have to calculate. How do I calculate? Simple formula is there. Forward rate is equal to spot rate into 1 plus interest rate of other currency divided by 1 plus interest rate of base currency. Simple way, spot rate into 1 plus interest rate divided by 1 plus interest rate. Which one will be numerator, which one will be denominator? Imagine I am telling rupee per dollar. Yes, here which is base currency. Yes, denominator is base currency. Normally base currency, I will be writing it in denominator. So base currency in denominator, other currency in numerator. Same thing using PPP. Here I will be considering inflation. It is spot into 1 plus inflation other currency divided by 1 plus inflation base currency. Okay, boss. Simple. This is one calculation. One more is calculation of premium discount that I have already discussed it here. Yes or no? Okay, boss. Two calculations are there. Now, based on that simple note, yes, interest or inflation rate I will be considering for the effective period of contract. Okay. Yes, compounding, if it is up to 1 year, I will consider simple interest. More than 1 year means I will be considering compound interest. Accordingly, yes, to the power of n, we will be doing as simple as that. This concept is over. Very simple. Okay, let the things settle in. We will continue the next concept. Yes, everyone. So next we are having concept number 3, which is going to be hedging techniques. In that, the first technique for hedging is forward contract. Now understand what is a forward contract. Yes, transaction is happening in future, but for that transaction, what will be the rate? That rate I am determining today. That is called as a forward contract. What all different rates can be there? Yes, first on the date of transaction, imagine today I entered into a transaction. Yes, today I will be having today's spot rate. Now for the future date, that is a settlement rate, 3 different rates can be there. Firstly, if I enter into a forward contract, my dealer or banker will be giving me a rate. It is called as my forward rate. Okay, boss. Now, yes, I am standing here. I am estimating. Yes, I am myself estimating 3 months later what can happen. Yes, what is my expectation? Yes, an expert will do. It is called as expected spot rate or expected forward rate. Company is doing that estimation. Is it real? No. We are doing estimation based on the information we know. Then, yes, there is the actual rate on that particular day. Actually, if I don't enter into a forward contract, on that day, actual spot rate will be there. It is called as actual spot rate on the date of settlement. Okay, boss. Now, understand, yes, first thing that question ICA can ask is calculation of expected spot rate or expected forward rate. That, okay, for the forward date, what is going to be the expected rate? How I can calculate? First is probability based forecasting. I call an expert. He tells, yes, these are rates can be there. This is a probability. I will do summation. Yes, rate into probability. I will add all these things. I will be getting expected rate one way. Or if appreciation depreciation percentage is given. Suppose question is telling, okay, boss, today $1 is at 80 rupees. 3 months later, dollar will increase by 10%. Can I do the calculation? Yes, sir. Simple. 80 plus 10%, 88. Okay. But suppose question told you that rupee fell by 10%. Now tell me, this quote is for dollar, but premium or discount is given for rupee. So I will have to convert it into dollar. Now there is a logical way to do it, but ICA doesn't do that. Yes, what ICA tells is ICA's logic is simple. I have told you that if one currency increases, other currency decreases. ICA is telling that, okay, rupee is falling by 10%. That means dollar will increase by 10%. Okay, boss. That means dollar today is at 80, dollar will increase by 10%. It will become 80 plus 10%, 80. Is this clear? So always we will be calculating gain or decline percentage for base currency. Yes, if gain or decline percentage is given for other currency in the question, then what will I do? Question tells you that other currency increases by a specified percentage. That means base currency decreases by that percentage. Other currency decreases by, say for example, 10%. That means base currency increases by 10%. Based on that, I will calculate my expected rate. That is today's spot rate plus or minus premium or discount for base currency. Is this clear, everyone? Okay, sir. Next is using interest or inflation rate that we have already discussed. Forward rate is equal to spot into 1 plus interest rate other currency divided by 1 plus interest rate base currency. Same thing is for inflation. Is this clear, everyone? Okay. Next, most of the times a question comes whether we should enter into a forward contract or not. Such questions will come. Now understand, yes, 3 different types of questions can come. Question number 1, whether a forward contract should be entered or not. Imagine today I imported goods. Today rate was 79, but today I am not making payment. I am making payment 3 months later. Yes, if I enter into forward now, yes, dealer is telling me, yes, every dollar you can pay 81 rupees. I did some calculation myself. Like 3 months later, what is going to be the expected rate of dollar? Is it actual rate? No, I'm just doing estimation. I got that 3 months later dollar value will be 80 only. That means, tell me students, if I enter into forward, for every $1 I have to pay 81. But based on my estimation, I'll have to make payment of 80 only. Will I enter into forward? No, I will not enter. Yes or no? So what will I do? Simple. I will see total receivable or payable if forward is entered using forward rate. Total receivable or payable if forward is not entered, that is using expected spot rate. Based on that, I will calculate profit or loss on forward. If I'm having profit on entering forward, enter. If I'm having loss, don't enter. Simple. Type 2 question will ask, calculate expected loss and how it can be hedged using forward. Now understand, how do I calculate expected loss? Imagine I imported goods of $1. Simple example. Yes, on today's value, how much I have to pay? 79. But I'm not making payment today. I'm making payment after 3 months. Yes, after 3 months, what is the expectation? Yes, what is the expectation? That $1 will become 80 rupees. That means how much loss I'll be having. If today I would have paid 79 only, but after 3 months, my estimation is that 80 I'll have to pay. That means 1 rupee is my expected loss. Is this clear, everyone? Okay. And question is asking how it can be hedged using forward. It means I will calculate expected loss if a forward is entered. Imagine here, if forward is entered, my rate is 79 only. Well, if forward is entered, imagine randomly I'm giving you rates. Yes, today is 79. 3 months later is also 79. That means my expected loss is going to be 0. Yes. Right now I was having 1 rupee expected loss, but if I enter into forward, my expected loss is 0. That means 1 rupee benefit I'm having. Is this clear, everyone? So look at this. Calculate expected loss if I am not entering into forward. That is, I will compare today's spot rate with my expected forward rate. Then I will tell what is going to be my loss if forward is entered. Is today's rate versus the actual forward rate. I will compare the two. If I'm having a benefit, I will tell okay, was enter into forward. Otherwise, I'll tell okay, not enter. Okay, then is a post-mortem analysis. It is telling actually by entering into forward, yes, was it beneficial or not? Here what I will do is, yes, my actual forward rate, I will compare it with the actual spot rate on the date of settlement. It is post-mortem analysis. Imagine I entered into forward. For every $1 I paid 81 rupees. Now on the last date, that is on the settlement date, I'm seeing if I did not enter into forward, what would have happened? Yes, on settlement date, in spot I would have had to purchase. Yes, what was the rate? Imagine the rate was 84. I'm telling okay boss, if I did not enter into forward, actually I had to pay 84, but because I entered into forward, I paid 81 only, 3 rupees benefit. Is this clear? So first I will see total amount if forward is entered, that is using forward rate. Second I will tell, yes, actually if forward is not entered, how much I'll have to pay. That is using actual spot rate on date of settlement. I'll compare the two and be taking my decisions. Is this clear, everyone? Okay sir. Third is going to be treatment of upfront premium. Suppose sometimes question will tell that okay, yes, if you want to enter into forward upfront at t is equal to 0, you have to pay some premium. It is always going to be cost to the company. Now this I am paying on date of transaction, but all other cash flow will be on the date of settlement. Now whenever cash flows are at different period, I will be including interest. So I will take it to the settlement date by adding interest. Yes or no? So always I will be doing upfront premium into 1 plus interest. Now how will I be showing the treatment? Simple. Yes, if I am having forward receivable, yes, I am receiving money. Yes, but from that, yes, dealer or bank will reduce the premium. So it is going to be receivable minus upfront premium into 1 plus interest. Yes, because of the speed, sometimes yes, words keep falling short of words. Okay, thought process is going so fast. Okay, I hope you guys are loving it. Next, in case of payable, yes, for dollar also, that is for foreign currency also I have to pay, premium also I have to pay. So it is forward payable plus upfront premium into 1 plus interest. Is this clear, everyone? Okay sir, this was going to be my first technique, that is forward contract. Or second is leading or lagging payment. I'm having due date. Yes, either I can pay early, leading date, or I can pay late, lagging date. Okay, this is possible only if that option is given by the supplier. In that case, what we are going to do? Now imagine on leading date, yes, first what I will do, I will see total how much amount I'll have to pay on the leading date. It is nothing but my invoice amount. Sometimes discount will be there, reduce the discount. Okay, leading date, how much payment I'll have to do, I got, that is in foreign currency. Now convert it into home currency. Yes, at which rate? Leading date exchange rate. Now I got, okay, on leading date total how much I'll have to pay. Now understand, simple rule of comparison, every cash flow should be on single date. I will take every cash flow to my lagging date. So from here I will take it to lagging date. That is, I will add interest from leading date to lagging date. Is this clear, everyone? Okay. Yes, imagine transaction is happening on due date. I will see total what is the invoice amount. I will convert it into home currency on due date. I got total how much amount I'll have to pay. Comparison purpose, I will take it to lagging date. I will add interest from where to where, from due date to lagging date. Simple. Lagging date, I will see total how much I'll have to pay. Sometimes it is going to be invoice plus some interest because I'm making late payment. Okay, I will convert it into home currency. How? Yes, on using lagging date exchange rate. I got the cash flow here. All cash flows are at this date only. I need not add any interest here. So all cash flows have come here. Yes, I'm making a payment. Yes, what do I ideally want? Wherever cash outflow is a minimum, I want that. So wherever my cash outflow is a minimum on lagging date, that is going to be the most preferred option. Is this clear, everyone? Next technique that we are having is money market cover. Beautiful technique, so many times it has come in the examinations. Students consider it to be difficult, but simplest thing to do. What is it? A simple rule, always create a reverse position. If I'm having foreign currency asset, create foreign currency liability. If I'm having foreign currency liability, create foreign currency. Three simple steps. Yes, I will call it as RCR. Reverse, convert, reverse. What is this? Look at this. First, I will write down the basic data. Then if I'm having foreign currency asset, that is I'm having receivable. Step 1, reverse. That is, I will create a foreign currency liability. Yes, to create a liability, I will borrow at present value. Okay, boss, I borrowed. Then what I will do? Yes, I will convert. Step 2 is convert. I will convert it to home currency. I brought the money here. Now, I don't want the money here. What I will do? Again, I will reverse. Yes or no? So, here I created a liability. Here I will be creating an asset. That means I will invest this. Yes or no? So, invest in home currency. Yes, and hold it till maturity. Your investment plus interest is going to be your total cash inflow on the maturity. Okay, boss. Second thing is, if I'm having foreign currency liability, that means I'll have to pay. First, step 1, reverse. That is, create a foreign currency asset. For that, I'll be investing at present value. Okay, I invested. Now, step 2 is convert. Convert it into home currency. Now, step 3 is again a reverse. Here I created an asset. That means here I am going to create a liability. That means in home currency, total how much liability? I will borrow in home currency. Yes, that on maturity date with interest, I will be paying. This is going to be the total cash. Simple, just to follow 3 simple steps. First, just remember you have to create a reverse position. 3 steps, reverse, convert, reverse. End of the story. Okay, next thing is miscellaneous strategies. In that, first is netting. I am having foreign currency receivable as well as payable. Point number 1. Point number 2, both are in same currency. Point number 3, both are for the same period. That means only the balance amount has to be hedged. That means I am telling, imagine 3 months later, $1 is receivable. Sorry, $1 lakh is receivable. 3 months later, yes, $70,000 is payable. Means until 70,000 is already hedged, boss. Balance 30,000 if you hedge, it is sufficient. Is this clear? Okay, next is home currency invoicing. Supplier tells, I don't want risk only. Yes, I am invoicing in my currency. Yes, if you want, you convert and give it to me. So supplier has no risk, but the payer is going to have the risk. Okay, boss. Next is currency futures as well as option. This is discussed with the chapter derivatives. So with this, we have finished the concept 3, that is going to be hedging techniques. Okay, let the thing settle in. We will continue. Next, we have concept 4, which is going to be fate of forward contract. That I am not going to discuss in this revision because it will take a lot of time. Yes, you will revise it once by yourselves, or at the end we will see separately if possible one more video. Next is concept 5, which is going to be arbitrage. What is arbitrage? It is a process to earn a riskless profit by exploiting mispricing in the market. Now, 2 different types of arbitrage can be there. One is geographical, one more is going to be covered interest arbitrage. Geographical arbitrage, in that 2-point arbitrage, 2 different currencies are there. Firstly, yes, which currency we want to purchase? Yes, tell me one thing, students. If I am buying base currency, what will dealer do? Dealer will sell base currency. Which rate will come into picture? Ask rate. So ask rate I am going to compare. Now, I am buying. I want to buy at a high rate or low rate? Low rate. So, yes, purchase in that market where your ask rate is low. Okay. Next, I have to sell also. Yes, where I will sell? Firstly, if I am selling means, yes, dealer will buy. That means bid rate will come into picture. Okay, sir. Bid rate is going to come into picture. Which bid rate? Now, I am selling. Ideally, when I am selling, I want to get more money. Yes or no? So, I will sell in the market where the bid rate is highest. So, I decided in which market I am going to buy and sell. Now, carry out the transaction, earn a riskless profit. Okay, next is 3-point or triangular arbitrage. This is when 3 or more currencies are there. Now, yes, very simple steps to be followed. First step is start with the currency in hand. Yes, question will tell you arbitrage has, yes, imagine $1 lakh. That means you're going to start with that dollar. Okay, then, okay, explore what all paths are available. Normally, 2 paths will be available for you. Yes, explore both the paths. Yes, write down what all path can be there. Now, start with any one path. You now understand that if in one path there is profit, in the other path there is loss. So, yes, how do I check? There is no way to check. It is random trial and error. Check with the first path. Your first path gives you profit. Great. Arbitrage process is completed. Yes, you earned your profit. Go back home, sleep. But the path selected is giving you loss. Wait. You go to the other path. Carry out the transaction. There you will be getting profit. Then you go back home and sleep. Is this clear, everyone? Okay, sir. Next is covered interest arbitrage. Here, yes, I am creating arbitrage using the interest rates. Now, first, very simple thing is, yes, if I am borrowing in one currency means I will be investing in some other currency. Steps, simple steps, students. Yes, in one currency I will borrow. Okay, assume USA and India. From USA I borrowed. I don't want the money there. I will convert it into other currency. Okay, all these things are happening at spot rate. Okay, I am borrowing in one country. Okay, I don't want the money there. Yes, I converted it into other currency. Yes, I got the money here in India. I am now investing in them. These three steps are happening on spot rate. Now on maturity date, I have invested in India. Yes, I will collect the investment proceeds, that is investment plus interest. Now I don't want the money here. Yes, I will again convert it into my other currency. Yes, I will get the total cash inflow in the other currency. Okay. Now in US, I have to pay my loan also. So repay your loan, that is loan plus interest. This is going to be cash outflow. Step 5 has given me cash inflow. This has given me cash outflow. The difference is going to be arbitrage gain. Okay. Yes. Now a very important question is, in which country should I borrow, sir? Okay. Simple thing. 2 steps you'll have to follow. Yes. Step number 1, calculate annual premium or discount in base currency. Step 2 is decision making. Now tell me a simple rule, students. If in India I am getting 10%, in US I am getting 5%, where will I want to invest? In India, that means where will I want to borrow? In US. So I will calculate the total return in base currency versus the total return in other currency. In base currency, I am getting 2 return. One is the interest. Along with that, I am also getting premium or discount. Okay, for that I have calculated premium or discount here. So total income in base currency, it is nothing but, yes, 1 plus interest rate into 1 plus, yes, premium or minus discount, minus 1 you get the effective return in base currency. Compare it with the effective return, total return in other currency. Other currency you will be only having interest. Okay, once you get that, imagine base currency return is more. That means in base currency you will invest. That means in other currency you are going to borrow. Is this clear, everyone? Note is going to be ensure uniformity in data. All calculation do it on per annum basis. Is this clear, everyone? Yes, concept 5 arbitrage is also let the things settle in. Next we are having the final concept 6, miscellaneous areas. Yes, we have come this far, my dear students. So part 1 is calculation of cross rate. So simple steps. Step 1, identify which currency customer is ultimately buying, which currency customer is ultimately selling. Based on that, determine the ideal quote needed. Normally, if suppose question is telling that, okay, customer has imported for $1 lakh, yes, for which currency ultimately that payment is receivable, payable, that itself I'll be considering as, yes, base currency. Okay, boss. Then create an entire flow of transaction. Start from the currency which current customer is selling. Imagine I'm an Indian customer. Firstly, I'll be having rupees. First, I will sell rupees. From that, I will buy something else. Then I will buy something else. Then I will buy something else. Create that entire flow. Okay. Once you've created that flow, based on that, determine your cross rate. How do you determine your cross rate? Yes, first try multiplying all the quotes available in the same order. If you cannot multiply, okay, yes, try using your inverse rate. Using that, you will be getting your cross rate. Yes, based on the cross rate that you have calculated, now finally adjust your exchange margin. Okay, yes, ultimately, finally only I will be adjusting exchange margin. Exchange margin bid is less, ask is going to be add. Okay, yes, inverse rate I have explained already. In case of one-way quote, it is direct inverse 1 divided by exchange rate. In case of two-way quote, remember bid means 1 by ask is going to be 1 by bid. Is this clear, everyone? Okay, sir. Next is going to be part 2, which is nostro vostro loro account, also called as exchange and cash position. Students consider it to be difficult. Very simple, students. 4 simple principle. Principle number 1. Yes, in exchange position, all transaction I will show, whether it is in spot or forward. Cash position, I will only show my spot transaction to test. Okay, sir. Yes. Principle number 2. Yes, whenever I am telling purchase, that means add. Foreign currency is added. Whenever I am telling sale, means foreign currency is reduced. Okay, boss. Purchase means add. Sale means less. Yes. Now, if transaction is happening in spot market, means it will come in exchange position also, cash position also. Imagine spot buy. That means add. Spot sell, less. Remittance by TT, I am paying. Yes, sell is again going to be less. Is this clear? Okay, transaction is happening in forward market. Yes, it will come only in my exchange position. It will not come in my cash position. Forward purchase, add. Yes, forward purchase cancelled, eliminate. Okay, less. Forward sale, less. Forward sale cancelled, reverse, add. Yes, bill purchased, draft purchased, DD purchased, wherever you see purchased, add. Yes, DD issued, draft issued. Yes, issued draft is cancelled. Yes, issue was less. It is now getting reversed. That means you are going to add it. Okay. Yes, simple format. Cash position. Yes, we will start with the opening cash balance. Yes, normally question will tell you opening balance credit or opening balance in nostro account. Yes, balance is always going to be positive. Yes, you will show transaction in cash position. Only spot transaction will come. You will get closing balance. Yes, in exchange position. Yes, opening balance is going to be overbought or oversold. If it is overbought means positive, oversold means negative. Okay, then I will show all transaction in the period, both spot as well as forward transaction I will be showing. I will arrive at my closing balance. Then finally, sometime question at the end will ask that, okay, we have to maintain this much balance in our cash as well as exchange position. So first finish all the transaction which is given, calculate what is the balance that is there. Okay, based on that, first maintain closing balance of cash position. Here I have to maintain the closing balance. Imagine right now balance is 10,000. Question is telling I want ultimately 5,000 balance only. That means what I'll have to do? I'll have to reduce 5,000. That means I will be doing a sell. Now tell me in cash position only spot transactions I'm going to show. That means it is going to be a spot sell. Is this clear everyone? So first I will be doing spot transaction. Yes, where all it will impact? It will impact a cash position. Yes, but it will impact exchange position also. In exchange everything is shown. That means this minus 5,000 will come here also. Revised balance I will calculate. Then I will calculate the value here in my exchange position. Then calculate closing balance of exchange position. For exchange position, now I will enter into a forward contract, forward transaction. It is going to impact my exchange position only. Is this clear everyone? Next is foreign currency exposure. 3 different types of exposure can be there. Transaction exposure, translation exposure, economic exposure. Transaction exposure. Transaction is happening today but settlement is happening on a different date. Because of that there is exposure risk. Okay. So yes, how do I calculate profit or loss? Based on today's rate, what is going to be total profit or loss? Yes, based on future settlement date, whatever is going to be profit or loss, its difference is going to be ultimate profit or loss. Translation or accounting, it is nothing but due to translation of our items. Yes, in the financial statement, it is just a notional item. Then is economic or operating exposure. Here understand what is happening. Yes, dealer, supplier is telling, yes, I don't want risk boss. I am doing home currency invoicing. So whether supplier has a risk, no. That means buyer is paying in foreign currency. Buyer is having risk, yes or no? Okay, yes. When buyer is having risk, buyer's price per unit keeps fluctuating. That means if his price increases, he will sometimes purchase less units. Price decreases, he will buy more unit. That means because of that, yes, the demand fluctuates. And because of change in demand, ultimately my profit is good. This is the entire story that is happening. What all steps I will be doing? On spot date. Step number 1, I will calculate the original selling price per unit. Yes, from buyer's perspective. Okay, at the original rate, okay, what is the selling price per unit? Okay, boss. Imagine initial rate per unit, he got it as 25. Yes, after that, some fluctuations will be there. After that, what is going to be the revised selling price? The revised spot rate, I will calculate. Based on that, I will calculate the percentage change in selling price. Okay. Yes, based on that, question would have given you what question would have given you? Elasticity of demand question would have given you. Yes or no? Sometimes in speed, okay, I do not get the words. Okay. Yes. Percentage change in selling price I got. Elasticity of demand is given. You multiply with the elasticity of demand, you will be getting percentage change in the demand on quantity. Okay, boss. Based on that, okay, now you got that ultimately how much percentage quantity is changing. Now on that change in quantity, on settlement rate, you calculate profit or loss. Is based on the change in the units. Ultimately, for the seller, using settlement date exchange rate, what is going to be the ultimate profit? Is this clear everyone? Then we are having, yes, concept for fate of forward contract. I have told I will not be explaining. Yes, there are 2 more things which I have not explained. One is fate of forward contract. Yes, one more is going to be, yes, currency options as well as futures, because that we will be discussing with derivatives. One more is, yes, where to borrow, where to invest decisions are there. Okay, yes, that also I'll be discussing it with other chapter, except that each and every point has been discussed. It is now 35 minutes. I hope you would have enjoyed. Very important caveat, I'm repeating it again. This video is not for conceptual clarity. Those students who have listened to AFM Forex from me, for them to quickly revise the chapter in the shortest possible time. This is, if you're listening for the first time, trust me, you will not understand what is happening. Even for the students who have taken class, sometimes at some point they'll feel okay, oh, okay, but if I try explaining, it will take more time. Okay, so on the day of examination, yes, every time you feel like you're forgetting things, just to help you revise things. Okay, so use it. You've loved it. It has taken a lot of efforts. Do like it. Do share it with all your friends. Stay subscribed. Do put your valuable comments. It really means a lot. Yes, it really means a lot. Not understanding what I'm telling as well here. Okay, so that's all for this video. Thank you so much, my dear warriors. Keep studying, keep smiling, keep working hard, keep making your parents proud, and see you for the next video.